Welcome to Yahoo Finance 2026 Outlook. I'm Josh Lipton, and for the next half hour, we're breaking down key themes for you, the investor, to watch as the new year begins. 2025 was a year filled with volatility, triggered by fiscal and monetary policy uncertainty and the concentration of market gains in tech tied to artificial intelligence. Many of the trends this year will carry over into 2026, and we have expert analysis and insight so you can prepare your portfolio. We've got you covered from stocks to bonds to crypto and more. Let's jump right in. One of the key hurdles for the economy toward the end of 2025, a record government shutdown. Not only did it affect growth, but also delayed or prevented the collection of key economic data. On the heels of the November jobs report, Julie Hyman sat down with RSM chief economist Joe Brusuelas and Academy Securities' Peter Cheer and asked them about their key drivers of economic growth.
So I think strategically, our main thesis on the positive side is what we're calling PROSEC, or production for security. So again, I think this does dovetail a little bit with Joe saying is that we are going to produce a lot more domestically where there is a national security interest. You saw some of that come out of the national security paper 2 weeks ago. And I think it's going to affect chips. It's going to affect data centers and AI where there's going to be help. It's really going to focus on electricity. I think electricity is becoming a far bigger election issue than the price of oil or gasoline. It's electricity. People are focused on it in and around the data centers, but away from that. And then I think you're also going to see this real focus on the rare earths and critical minerals, not just the extracted versions, but the processing and refining of them. So that's going to be kind of the growth side of it. I think you're going to see some states embrace deregulation and things that allow those businesses to grow. And I think you're going to see some states fight this. So you're going to see a little bit economy there. Away from that, I think tariffs are finally starting to have a little bit of a bite. I'm not seeing companies being very energetic in their spending and growth forecast for next year. So I think if the AI data center stuff slows, and I expect it to start slowing, you're going to see a drag on the economy. And I think that's what's going to force the Fed's hand. And a lot of these things, especially the tariffs, they take time to play out. We're now probably about $250 billion of tariff revenue collected. That is starting to have a meaningful impact to earnings potential, and it's going to start probably spreading its way to the consumer a little bit. So that's why I'm overall bearish. With that PROSEC, or production for security, is where I'm trying to invest heavily.
And Joe, on the flip side, you and I were talking during the break, and you are looking at this stimulus that's going to be coming into the economy as a result of the tax cuts. How much is that going to be able to offset some of the risks that Peter's talking about?
Well, you're going to get a pretty big and fresh injection of cash in the first half of 2026. Look, you've got pretty big tax cuts that are tilted towards the upper end households. You've got full retroactive expensing to January 19th of this year, right? You've got deregulation. I don't know if you guys have noticed, we're kicking the tires and lighting the fires on a pretty big credit expansion, right? Especially in private credit. The banks are going to join the party next year, right? And then you're going to get two rate cuts next year, right? As we normalize down to down to 3%. Mm-hmm. So I'm expecting at least $55 billion, perhaps closer to 60, right away as these tax withholding tables are adjusted. Then closer to 70 billion in corporates. So you're going to get a pretty big injection of cash here.
But how is that cash going to then be dispersed? In other words, by the entities that are getting it. Also, if you say the tax cuts are weighted towards the highest income households, that doesn't help with our K-shaped affordability crisis situation.
No, that's not going away.
Right?
Yeah.
And do the companies use that cash to hire people, or do they use it to spend more on compute?
Well, they may actually invest in the companies in productivity enhancing investment, which is good for the real economy. The way I look at it is, we've had three big shocks this year to the economy: trade shock, immigration controls, and then the government shutdown. This is 2025 ended up being a lost year. We're going to finish up probably 1 to 1.5% growth year over year. But I think that the dynamic properties inside the tax bill should facilitate 2.3 to 2.5% growth next year. Now, in a $30 trillion economy, that's a big move.
So
right?
I got to bring Peter back on this because, Pete, what do you think about the stimulus, the tax stimulus that's going to be coming in, and what effect that could have?
I think it definitely helps. Again, the question is, do companies really have the confidence in this economy to grow and spend on plant, property, equipment? Will they do much? Have they already questioning how much they're spending on AI? Will they take this as a buffer that last year maybe they had to loosen up some of their coffers to fill that. So I see the money coming in. I'm less convinced that drags through, especially to the markets, right? Again, the economy and the markets have diverged a lot, right? This year we had kind of this jobless economy, and yet we had stocks do extremely well, especially since Liberation Day. So I could easily see a bit of a reversal of that, where you see the markets come down a little bit, the markets be a little bit nervous, while maybe the overall economy hums along okay. And I kind of refuse to call it the K-shaped economy. I really think we've shifted into what I call the little I-shaped economy, where you have this little dot that's doing extremely well, and the rest of the economy, the big stick, is kind of okay at best. So I think it's slightly more, isolated who's doing well. So again, I don't know that you see quite as much follow through to the broad economy. I think it will help smaller and mid-sized companies better because they bore the brunt of a lot of the problems this year. But I don't think it's going to be enough to be great for stocks next year.
Yeah, that kind of speaks to the firestorm, I guess, that Mike Green of Simplify ignited when he said the real poverty line for a family of four is $140,000, which speaks to the littleness of the I and the bigness of the rest of everybody else potentially. There's one more thing I want to ask you about, Peter, and that is the Bank of America December Fund Manager Survey, which was the most bullish in 3.5 years. And it feels like once again here that we are in, the vibes are not matching what's happening, right? Like the market, to your point, the market seems great, or the vibes seem great among fund managers, and yet there's this disconnect with how people in the real economy are feeling.
Well, also, that's always the danger, is right? Once everyone's kind of all in, any hiccup results in pretty heavy selling. You saw last week a couple companies, in the tech sector had small misses. You read the report, they didn't seem that bad, and yet the stock was down 10% that day, dragging it down. So I think this is, everyone's kind of all in. Everyone wanted to show they had as much exposure to some of these sectors that had been doing well. So it doesn't take much of a question mark to bring these down. And I think what we're going to see is, at least from some of the tech companies, it's not going to be a full-on debt diet. They're not necessarily going to, cut their spending plans, but I think they're going to have to be much more careful and not say, hey, we're going to spend at all costs. We went through, say, a year ago where if you said you were spending 10 billion, boom, your stock went up 20 billion, roughly, right? So you had almost free money. That has now changed. People are checking that spending. There is concern in the private credit market. There is some concern in the public credit market about the amount of money coming in, not just to fund the data centers and AI, but as Joe pointed out, it's going to be how do we fund the energy production and electricity production more specifically to get those. So I think there's a bunch of headwinds, and that has been such a strong leader that's why I just don't think the markets can really go higher until we see some selling, get people back to maybe a little bit of nervousness.
Up next on Outlook 2026, a closer look at the bond market and what to expect from Washington when it comes to crypto regulation. The U.S. economy is entering the new year with notes of uncertainty drawn up throughout 2025, mixed signals on the state of the labor market, concerns of an AI market bubble, and the murky path for interest rates all carrying into 2026. So what could be ahead for the economy? Mohammed Al-Arian, Chief Economic Advisor at Alliance, details it all with Yahoo Finance's Julie Hyman.
So let's take the AI-fueled productivity first. It doesn't feel like we're there yet. And so I wonder, do you think that does start to really take hold in 2026? Is it the later part of 2026? And sort of what does that look like? How do we see that unfolding?
I do see it taking hold. So right now we're obsessed with those working on AI. Gemini 3, how wonderful it is. Oh no, wait, OpenAI is going to come up with something.
Yeah.
It's all about those working on AI. We haven't focused enough on those working with AI, the adoption issue. We don't have an adoption policy. It's not hard actually to put in place an adoption policy. If you freeze those working on AI where they are and you simply implement throughout the economy what they have achieved, you have a major productivity growth. That is only in AI. What about robotics? That is coming down the pike in an important way. So I certainly think that we will see it play out over a number of years. There is a possibility, not a probability, a possibility that it could be accelerated, but that requires corporate America to really increase the adoption rate.
Are you using it? And which model are you using? Do you have a favorite one?
So I use it all the time.
Okay.
I use Gemini. I think it's incredible what it does.
Like, what do you use it for? I'm just curious. I mean, I use it when I'm doing research for interviews, for example. I've been using Gemini also. So how do you use it?
So I use it for that.
Yeah.
I use it for checking what I write. I use it for looking at slides I use when I teach and ask a simple question, how do I make this more engaging? I use it for a whole range of things, and it has really increased my productivity. It also increases the time I spend on it because I get very intrigued by certain things, but it's incredibly powerful. I generate images, and you'll see, if you look at my weekly, you'll see the image generated. Underneath I put generated by AI. Right. And I simply say, when I read a long report, just to make sure I don't miss anything, I say, summarize the main points. So I use it all the time, and I find Gemini 3.0 incredibly powerful.
Yeah, like I say, I've been using that one too. So, okay, so that's the one side of it. Let's talk a little bit more about Treasury supply, the bond market, because we've already seen little glimmers of that, right? At a time when the Fed is cutting, very unusually, 10-year and 30-year yields are going up. So is that a sign of things to come next year, that we could see more of that phenomenon in the bond market, especially with more Treasury supply coming to market?
So there's tremendous supply from the public sector and from the private sector. Data centers now alone are going at a rate of 150 to 175 billion a year in terms of debt issuance. That is big. Then you have a 6% of GDP deficit. That's big for this part of the cycle. What I worry about is at some stage the bond market is going to say, you know what, we're not pricing in risk the way we should be pricing in risk. That is part of the downside scenario we talked about, is that the bond market's appetite, which has been incredibly strong, somehow becomes less so.
And where do you put that probability?
So I have, and that's not going to satisfy you, I have a 50% probability for the central scenario and about 25% for each side. Okay. And the big message of this, whether you're a policymaker, whether you are a market participant, whether you are a CEO, don't fall in love with your central scenario. Just recognize that it's a multimodal distribution, and you've got to pay attention to the tails, and you've got to ask yourself, which tail can I navigate better?
Yeah, I mean, that's a good lesson over the past few years. Don't get too wedded to that central scenario.
2025 was the year of crypto as adoption went mainstream and Bitcoin hit an all-time high above $120,000. Crucial catalyst for the industry, the regulatory backdrop, and there is more optimism ahead. Here's what Coinbase Chief Legal Officer Paul Grewal told me on where things stand, where crypto meets Washington.
The Senate is considering their version of the Clarity Act. And what the Clarity Act, which passed the House early this year, would provide for the first time is a true market structure for crypto here in the United States. Now, earlier in the year, Congress passed and the president signed a bill regarding stablecoins, which is an important first step in providing clarity and certainty under the law for crypto and digital assets. But it's really time, it's essential that Congress finish the job. And that's what it will do when the Senate finally passes market structure legislation in short order and the president signs it.
Paul, you mentioned stablecoins there. Now, Brian Armstrong also did talk about that. He said banks are exploring stablecoins after Congress passed the Genius Act. I'm curious, Paul, what does that mean, do you think, for the adoption curve?
Well, there's no question that traditional financial institutions, including banks, now understand very well the power and the potential of stablecoins to bring transformation to the financial services industry. And what it will mean, of course, is greater adoption, greater utilization, and improved efficiency throughout the financial system. We are pleased to see banks finally wake up to the realization that it's time for innovation in the way we move money around on the internet, and we're delighted to have them as partners in this space, and look forward to their full participation.
Now, Paul, it wasn't just Brian Armstrong, your colleague at Deal, but we had Larry Fink there too. Here's another big name. He said Bitcoin, that was interesting, he said Bitcoin remains heavily influenced, Mr. Fink says, by leveraged players. And I'm curious what you make of that, Paul. I mean, how much risk does leverage sort of still pose here? And how does Coinbase mitigate that?
Well, Coinbase has provided access to Bitcoin for millions of Americans, really going back to the earliest days of crypto. But it's a market like any other market that evolves with time, and it's natural to expect that individuals who may have been less familiar or even less comfortable custodying their own Bitcoin and holding it in their own wallets would want to rely upon intermediaries of all types in order to fully participate and finally participate in this market. We are seeing leverage and additional intermediaries relying upon leverage introduce new options for consumers to participate in the Bitcoin revolution. And that, of course, will require there to be new standards, new requirements, and new safeguards put in place. But we think that the market structure legislation is key to facilitating that. It will define for the first time which assets are subject to the securities laws of the U.S. and which assets fall outside of those laws. And we think that concerns regarding leverage and many others are best addressed by Congress and the agencies charged with writing rules once Congress acts.
Coming up, we hear from one expert on what America's corporate leaders are getting ready for in 2026. That's next. Tariffs, trade policy, and geopolitics move markets in 2025. Yahoo Finance's Julie Hyman spoke with EY Global's Courtney Rickard-McCaffrey about what's the top of corporate America's mind for 2026.
Certainly, almost every client conversation I had this year really did revolve around tariffs, which ones were likely to be enforced, how the outlook would proceed from here. And I think, unfortunately, the message for 2026 is that uncertainty around tariff policies remains. It may be a little less volatile than what we saw in 2025, but we do expect not only tariffs, but also export controls and other sorts of trade restrictions and incentives to continue to be introduced by various countries throughout the year. We could see new trade deals as well. So I think, in terms of how CEOs need to plan for these things, I do think we'll see continued volatility around specific product rates, as you were just mentioning, as well as rates for specific countries as well.
And so how do executives then, I guess they've had some practice this year, they've gotten some practice, but how do they go about tackling that when it is so volatile?
Yeah, absolutely. And thankfully they have built up those muscles this year, so they will certainly need to continue to exercise them in 2026. What we've seen is not only in terms of tariffs, but also, other types of geopolitical risks that are unpredictable in the current environment. We're seeing a lot more companies turn to tools like scenario planning. 66% of the 66% of the companies that are best at managing geopolitical risk use scenarios to set their strategy and to test their strategy. So I think that will continue to be a key tool in the toolkit going forward.
And I think one of the other things you highlight that's really interesting that's related to tariffs, because tariffs have been used as a tool in this way, is scarcity of various resources, whether those resources are critical minerals, which have been at the center of some of the tariff and trade back and forth, or talking about things like water as well, which has become, it's not only vital for life, but also has become important for things like data centers and cooling in some cases. So how is all of that going to play out, and what do people need to pay attention to?
Yeah, absolutely. So we do see geopolitical competition for either the continued control of those resources or for greater access to those resources really being a key story in 2026, and will drive a lot of the policies from governments, as well as a lot of the implications for companies, both in terms of risks as well as opportunities to expand in certain areas. So certainly freshwater, you mentioned critical minerals. Both of those are really key to data centers, to electricity production. So those are two really critical types of resources that we see governments that will really ramp up their competition in that area. And we could see some going it alone, others trying to reach out to allies and partners to really build those critical supply chains.
Now here in the U.S., Courtney, looking at another one of the things that you're watching, here in the U.S. rates are trending lower, but we've not necessarily seen rates in the market trend lower. And what is happening with the borrowing cost atmosphere and environment around the globe, and what should we be watching for in 2026 there?
Yeah, absolutely. This is another one of those scarce resources broadly defined that we point to in terms of capital. So what we're seeing is a lot of geopolitical competition around access to capital and the growing politicization of capital allocation within different economies around the world. So we think this will really continue to reshape or refine the global financial system. So, there's, sovereign debt issuance is at an all-time high. Debt servicing costs do continue to grow, though, and so we could see some fiscal pressures in certain countries. And how this sort of plays out in terms of the private sector's access to capital and the cost of capital, I think remains to be seen, but bears watching closely as the year progresses.
Courtney, as you know, AI has been like the theme of this year. What are you watching with reference from your perspective? What's important about AI next year?
Yeah, absolutely. I think the buzzword this year has certainly been sovereign AI, and I expect that to continue next year. So we are seeing governments around the world really trying to accelerate the development of AI value chains and algorithms within their own economies, because that is seen as critical to economic security and national security going forward. So we'll see governments really focus across the AI value chain. It's not just about those algorithms, it's also about the critical minerals that go into the semiconductors that power the data centers. And of course, data itself is a critical resource as well.
That's a wrap for Outlook 2026. Thanks for watching Yahoo Finance.